Jonathan Camarda, Chief Investment Officer. Hopefully you guys are all doing well. As we come to you very close to the end of the first trading week in September, Jerome Powell came out still sounding hawkish, regardless of what some of the other members earlier this week had intimated, like a Brainerd and such. And so we're looking at 75 basis points later this month in September. And what was once thought to be 50 maybe in November is more likely now. The odds look like 75 basis points again. So a double shot of 75. Very little neutral talk from him as well. Now, you've heard some of the large institutional fund managers, I won't name names, you've seen them on TV, talking about how harsh that these hikes are going to be as we move into a heavier recessionary environment in 2023. And then we're also looking at a Fed perhaps not raising rates early in the year, but not reducing them either, at least until mid-year, which could create a very, very Sierra dry environment for business over that time. We shall see. Don't want to look too far through the telescope into 23. 22 has plenty on its plate for us. So what do we have right now? Well, right now we have a market that actually took it in stride today being September 8th, at least for a few more hours. And so what we're looking at is the indices all below their 50-day moving averages, which are below their 200-day moving averages, which is obviously in a bearish position. However, again, if there's some short-term momentum from an oversold condition that we had in August, the market could surprise as we move through October. Now, economically, it doesn't really make sense because when you listen to the Fed and don't fight the Fed, generally in an up market, when the Fed is easing, people that are on the sidelines, they're fighting the Fed, they miss out. But when the Fed is tightening, right, reining in those easy policies, you don't want to fight the Fed by being overly aggressive. So if you look at just PE ratios and some other metrics, return on equity, different cash flow, income statement dynamics of companies in this environment, not to mention balance sheet dynamics, it doesn't make sense for markets to rip to the upside. There doesn't seem a whole lot of growth in a PE ratio, what they would call as the PEG ratio, price to earnings growth ratio there, not to get too wonky on you, to be that optimistic. But that doesn't mean that the market can't whipsaw to the upside. So we want to keep our head on a swivel to see if there are opportunities like July, right? So as we move into October, it'll be very interesting here to see where the market goes. Now, sectors that are looking attractive regardless right now, as they have all year, utilities, which we've had a position in many of your strategies. Energy's pulled back, but still in a longer-term uptrend. The supply-demand macroeconomic picture, very good for energy, at least right now in the last two earnings cycles, last two quarters. Obviously had the most robust earnings reports as well. And so as we move through the fall, we have to really be cognizant if there's opportunities in certain sectors and not be overly optimistic on short-term runs within an overall downtrend. Now, the thing that we're also watching are Treasury rates. As rates go up, energy's elevating, dollars going up, that has been a negative for equities, right? So it's almost a inverse correlation that we've been able to watch. And in some of your strategies, you're even making money in active capital preservation, for example, by being long interest rates, which would be net short treasuries, okay? So where we see things, that's pretty much where we are. We're kind of on the side of a coin here to see, again, if the market can break through or if it gets resisted with the, again, dour economic overhang that we're still looking at. That being said, as we maneuver through the fall, again, into the election, historically elections have been generally green shoots post-election to the upside and a seasonally strong time of year, usually from late November into the new year. Again, we'll be watching that as well. So there may be pockets here to take opportunities and take advantage of those opportunities. But at the same time, in this type of market, we do not want to get whipsawed and then take aggressive positions where the overall trend is down and the Fed is not our friend. Okay, so we want to make sure that we understand where we're at. So that's why I say all of that, because when you look at your strategies, in some cases very vanilla and defensive from being opportunistic in July, we just want to look, proverbially speaking, both ways before we cross, right? In a downtrend, we had a dead cat bounce in July. My wife and girls probably not too happy with that expression, but that's what we had in July. And again, in August, we saw the reversion. So with that being said, we continue to look for opportunities globally. Not many opportunities. Worse shape than us, China. I mean, have you looked at what they're dealing with? The shutdowns, the heat, the real estate bubble. I mean, it's just unbelievable, the real estate bubble that's going on there. So they're economically, I think the GDP is looking at less than 3% forecasted. When was the last time you saw that? I think it was like 2.7. So they're in a very weak position economically, as we've had some strains recently with them, but they are very cognizant of their own weaknesses there. And then even worse is obviously Europe, which is just a total mess. Energy, inflation, agriculture, just a very rough spot for Europe, which is why you'll notice, again, unlike an asset allocator who typically has diversified exposure everywhere at all times, we do not. We prefer to look at the real estate and look at location, as in being the environment and not just being invested in areas for the sake of a pie chart. So Europe, very, very, very dire as well. Opportunities right now, too soon to really see whether we'll take advantage of them. India and Thailand are actually attractive in emerging markets as the two little glimmering stars in an otherwise cloudy sky of the global economic picture. So with that being said, as we move into late September and then the next hike and what the environment's like, if anything changes for you individually, that changes your risk appetite or idiosyncrasies that your personal wealth advisor needs to know about, obviously reach out so we can sculpt exactly what you need out of your portfolio. As again, we always remember that you earn the money. We're just privileged to help navigate it through this turbulence, and we take that very seriously. So we appreciate your time, your patience, and most importantly, your trust. Till next time, Jonathan Camarda, stay frosty.